Welcome to AHA Math and Science. In today's video, we want to discuss value versus growth. So we all know growth stocks usually kind of outperforms value stocks, but they are more volatile. On the other hand, value stocks are a lot more stable, but they kind of like have a low return compared with growth stocks. So in today's video, we like to use Vanguard, some Vanguard funds to do the comparison. So the first pair is VBK versus VBR. So the VBK is the Vanguard Small Cap Growth Index Fund, while the VBR is the Vanguard Small Cap Value Index Fund. These two funds have a net assets of around 28 billion and $46 billion. So shown here is a plot of the share price, kind of normalized by the value in January of 2005. So you can see both funds kind of doing well. They are kind of generally on uptrend. You can also see that the small cap growth, which is this pink curve, slightly kind of outperforms the small cap value. In fact, when you actually plot this ratio, which is this green curve, this ratio of growth versus value, you can see this ratio is kind of steadily increasing. Maybe not a huge increase, but it's increasing. And then this ratio even kind of like went above 2 in 2021, meaning that the growth is really kind of outperforming the value during that time period. So let's take a look at this ratio of growth to value more carefully. So when we actually plot this ratio of growth to value on a log scale first time, now if the two underlying securities are kind of follow the compounding formula, then we expect the ratio of the two underlying funds. We also kind of follow the compounding formula, meaning that this ratio plotted on a log scale, they should more or less follow a straight line. It looks like actually this data does sort of like follow a straight line. And when we actually fit the data with a straight line, we find that the R-square value is 0.40, meaning that it can fit the data, but it's not a great fit. So the R-square value is a measure of how good the fit is. So when the R-square value is 1, meaning that the fit is perfect. So the data can be perfectly fitted by the straight line. Here you can see actually this ratio goes kind of fluctuate a lot, sometimes above it, sometimes below it. So here it's basically outperformance, huge outperformance. Here, well, it's more or less like becomes like not a outperformance. It's actually more like an underperformance. So this statistical analysis also says that you can plot the standard deviation lines above and below it. Shown here are the two pink lines, which are 2 standard deviation above and 2 standard deviation below the trend line. And the statistical analysis says there's 95% probability for the price to kind of fall between the plus minus 2 sigma. Indeed, that's the case. You can see like very rarely, except here maybe, it's going above the 2 standard deviation. Here it just kind of goes below the 2 standard deviation briefly. Now, you can see that the R-square value is 0.4. So it can fit the data, but it's not a great fit. So this pair of like small cap growth and small cap value may not be like the perfect trading target to kind of exploit the advantage of value and the growth at the same time. So let's take a look at another pair. These are the VUG and the VTB. So VUG is a Vanguard Large Cap Growth Index Fund, while VTB is a Vanguard Large Cap Value Index Fund. The two funds have net assets around $150 billion. Now you can see that when plotted all these versus the share price versus time, you can see both are on a very nice uptrend, except maybe during the great financial crisis, and then just kind of in 2022, the bear market we are currently having. But you can also see that the large cap growth really kind of outperforms the large cap value most of the time. It's always kind of above, except maybe here it's kind of the large cap growth underperforms the value a little bit. And this ratio, when plotted here, you can see is kind of steadily increasing, meaning that yes, growth is kind of outperforms the value. In fact, the outperformance is getting better and better over time. So now let's take a look at this ratio of the large cap growth versus large cap value carefully. And just using the same analysis, we plot this ratio on log scale, and you can see that this data now follow this straight line much better. In fact, when we fit the data, we find the R-squared value 0.75. Not as high as like 0.95, but you can see that the fit is decent. You can see that it's the clear uptrend. So this is the ratio. So the ratio of growth to value. So as this ratio is increasing, meaning the growth is outperforming value even more and more. But occasionally you can see this outperform just kind of goes out of this straight line too much. So the statistical analysis says once you plot the two standard deviation above and below the trend line, so the red one is the trend line, this is the two standard deviation above, this pink line is two standard deviation below the trend line. There's a 95% probability for the price to kind of fall between this range. And that's the case. So you can see like very rarely here it kind of goes above, here it's below. So now if one is kind of like want to be fully invest in stocks all the time, and then you only have this you only want to kind of choose value versus growth to these two categories, what would be the best strategy? So since the growth outperforms the value most of the time, so if you are you want to be fully invested in stocks, then you want to stay in the growth stocks most of the time because it outperforms the value most of the time. And then when the outperform just goes too much, for example, at here, it's not going above 2 standard deviation, that outperformance cannot sustain itself. So it's going to fall down. So that would be a place that one can sell the growth and then buy the value stocks. And similarly, when this ratio goes below the 2 standard deviation, which cannot stay there for too long, one can sell the value and then buy back the growth stocks to kind of capture the increase of the growth stocks, that outperform the growth stocks. So by using this strategy, what will be the performance? Well, we can plot the blue curve is the large cap growth, and the pink curve is the large cap growth. The large cap growth and the blue curve is the large cap value. Now, when we do using this strategy, we sell the growth stocks and then buy the value stocks in the middle of 2020, a few months after the bear market during the pandemic. This is when it looks like the growth is just outperforming the value too much. So you sell the growth and buy the value. Now, initially, the model performance is going to be below the large cap growth as expected because large cap growth is still increasing. So the timing cannot be perfect. So you can only kind of timing everything perfectly, right? So right at here, you can see that the model starts to outperform the large cap growth because the large cap growth just is going to have a very sharp drop during 2022, the bear market. So it starts kind of outperform the model, outperforms the large cap growth. And then when the large cap growth drops too much, and the signal already kind of tells it's now 2 standard deviation below the trend line. This is a place that one can actually sell the value and then sort of get back into the growth stocks. And that way you can catch basically the sharp increase of large cap growth. And in the end, the model performance has a very nice return. It's actually an 8-fold return since 2005, which is in comparison to a 4-fold increase for the large cap value and then 6-fold increase for the large cap growth. But you can see that not only the model has a much better performance, but also the volatility is kind of reduced. So this is really kind of nice strategy for those who want to kind of be fully invested in the stocks. And you can actually choose that if you have a pair of targets, you can compare to see which one outperformance. So in this case, we are comparing value versus growth. So for the large cap growth to the large cap value, we found this ratio is kind of mostly on uptrend. And our strategy is basically to be fully invested in the growth stocks and then swap out the growth and get back into the value when the growth outperforms the value too much, right at here. It's already above 2 standard deviation. And then at here, the value is outperform the growth too much, then you want to sell the value and get back into growth, and then just kind of capture the sharp increase of growth, in this case, for the past few months. So I hope you have enjoyed this video and find the information presented here interesting. Your support really kind of means a lot, and so that I can produce more videos like this one. So please do not forget to click the like button and also subscribe to our channel. And thank you for watching.